All right, welcome to Module 10, everybody. This is where we're going to start talking about getting into some of our more long-term strategies for using other people's money to fund your cash flow creating and wealth creating real estate transactions. So, as usual, we need to start off by discussing our disclaimer here. I am not a licensed attorney, accountant, financial advisor, broker, agent, or any other licensed individual. I'm just a student. We've got some strategies here that I've been able to be very successful with over the last few years, and I want to share them with you. So hopefully everybody's okay with that. We're going to talk about SubjectTo/equity blend. The SubjectTo equity blend. So what is SubjectTo? What does that even mean? SubjectTo is short for the term purchase subject to the existing financing staying in place. That is a long definition or explanation of and title to a strategy, but it's kind of on the nose. It's self-explanatory. This is you purchasing the property subject to the existing financing staying in place. That means that the previous owner is going to leave their mortgage in place, and you basically just take over the payments. You may have heard other terms for it. Some people call it a wraparound mortgage. Some people call it a sandwich loan. SubjectTo is one of my favorite acquisition strategies for long-term rentals because it transfers the ownership to me. So I get the title, or my company gets the title, while leaving the seller's name on the mortgage. And, it doesn't go on your credit. It doesn't go on your name. At least on the mortgage side, the title does, which is awesome. It's kind of the best of both worlds. Now, these are very involved strategies. This is definitely not a beginner strategy. This is more of an intermediate strategy. So always involve an attorney in these types of transactions, as there are many, many moving parts to this. Now, let's talk about seller negotiation. How do we get sellers to leave their mortgage in place? That sounds like something that nobody in their right mind would do, right? So one of the things is by, if you go back to our other class, Finding Off-Market Deals, we talk a lot about where to find deals where we can help people out of bad situations. We focus in the lead generation step, we focus on finding properties or people that are in distress, and we come in and we make an offer on their property to help them out of their bad situation. So primarily what we're looking for here, and where I've had the most success with the SubjectTo strategy, is finding people who are behind on their payments. Because if we can just bring in that little bit of cash to catch them back up on their payment and help them avoid foreclosure, that's going to help them out in a lot of ways. First of all, they're not going to have a foreclosure on their credit, so the time for them to work on credit repair is going to be a lot shorter because of this help. And second, they're going to lose the house anyway. So the fact that they've got to still move out, I mean, that's something that should be fine with them. And if we frame it right in our negotiation, look, you can either lose your house and your credit, or if you do the deal that I'm suggesting, you lose your house and you're able, if you work on it, to repair your credit faster. That's how I'm always able to get people to at least start to listen to my ideas around the SubjectTo strategy. Avoid using terminology that the property owner wouldn't understand. So don't say subject to them. They're not going to know what that is. Many of you probably didn't even know what that is until I just explained it. Instead, ask them if they'd like you to take over their payments, or and kind of talk about how that works. So instead of saying, "Hey, would you be open to a SubjectTo purchase?" They're not going to know what that is. But say, "Hey, what if I took over your payments? What if I caught you up on your mortgage and took over your payments? Would you be willing to move out of the house? This would be something that that would potentially allow you to repair your credit faster, so you can enjoy home ownership again sooner." And a lot of people are open to that when you position it right. If they're a distressed seller, don't open by talking about their problem. Don't when you generate the lead, don't immediately call the homeowner and say, "Hey, you're going to lose your house, right?" Because that starts it off on the negative, on a negative foot. You don't want to do that. Instead, open with something a little more benign, like, "I'm looking to purchase a home in your neighborhood. You're stuck out to me. Would you be open to receiving an offer?" If you use language like that, then it's a little more neutral, and it's kind of starts it off on better footing, and you're going to have the ability to enter into a conversation with them at that point. So here's the thing about SubjectTo. A lot of times we've got to come up with money to catch them up on their payments, and then in some cases we're going to need a little bit of money to cover a couple of months worth of payments on their mortgage, and maybe do a little bit of rehab, maybe some carpet and paint while we're trying to turn it into a cash flowing rental property. So you probably will need an equity partner. Now we've covered how to talk to and find equity partners and private money lenders already in this course in earlier modules. But just as a quick review, remember that you have to tap into your existing network. If you're going to raise money from private individuals without a securities license, it can only be from people that you have a prior relationship with. Remember to talk about real estate investing in casual conversation. If you're at a barbecue or hanging out at your brother's house or your sister's house or grandma's house, always be talking about what you're doing. Talk about your real estate investing ventures and the properties you're looking at, and build intrigue around the idea that you're a real estate investor. Attend investment clubs, attend local networking groups. Do everything you can to maximize the awareness that you are a real estate investor, and awareness around the activities that you're doing as a real estate investor. Now remember our word of caution, it's illegal to solicit funds publicly. So you can't hop on Facebook and say, hey guys, anybody that wants to join in on me with this deal, here's the rate of return I'm offering. That's illegal. You can't do that. You have to have those conversations individually with people that you have a previous relationship to it. So, I don't want to end up hearing that one of you got thrown into jail because you were raising funds wrong. That's pretty cut and dry. Don't publicly solicit funds. You can only do that in a private way. The way that you make people aware of what you're doing is by just talking about your real estate investing activities in general, both in social networks and in public forums, as well as in private forums when you're hanging out with people and when you're having private conversations. So that's the best way to find your equity partner. And if you want to dig a little bit deeper in that, go back to some of the earlier modules, the module on the equity partner module, as well as the private money debt module. That's going to have a lot more for you on where to find these types of equity partners and people who are willing to come in and structure a partnership with you. Now, this works a lot like the debt equity blend in the fix and flip side, in that you're going to structure a partnership with them via an LLC or a joint venture agreement, and then they're going to share in the cash flow with you. They're going to share in the profit, the cash flow. When you sell the house, you're going to have equity and appreciation. They're going to share in that with you. You're going to have deductions that you can take in rental properties, so they're going to want to share in that with you. There's a lot of things that you can bring to the table and offer to an equity partner to sweeten the deal, so that they're ready and willing to jump in at any time with you on a given rental. So let's talk about how to handle title, because you doing seller financing of any kind, and SubjectTo is a form of seller financing. When you take title on a seller finance transaction, it's important to know how that title is transferred. And so here are some of the most common ways. We'll go over three of them. The first is an all-inclusive trust deed, or AITD. This transfers the title and the rights to the property to you immediately. This is used for properties with underlying mortgages. So in a SubjectTo transaction, you need to use an AITD, or an all-inclusive trust deed, when purchasing a property, if you're going to leave the previous owner's mortgage in place. Now, let's talk about some of the other ways. Note and a deed for trust. And this is stuff, by the way, as you're writing up the offer, if you're using the state-approved REPC, we've discussed the real estate purchase contract. If you're using the state-approved real estate purchase contract, usually there is a state-approved seller finance addendum that goes along with that. The best way to find that is just use a search engine. Type in your state and then the words seller finance addendum or REPC seller finance addendum, and that should pop up. That should be one of the results on the first page. Just grab the PDF, fill it out. In most states, they ask you, is this going to be transferred via all-inclusive trust deed, note and deed of trust, or contract for deed? I have seen in some states, in lieu of all-inclusive trust deed, they'll put something like note and a deed of, it's slipping my mind right now. We'll come back to that. I'll put it in the notes. But all-inclusive trust deed, AITD, you're going to see that on that addendum. Just make sure you check that box if there's an underlying mortgage. Also, that's going to be something that you want to communicate to your title officer, that it's an all-inclusive trust deed. And then they'll know how to transact that that property. For subject-to transactions, I prefer an all-inclusive trust deed when purchasing and a contract for deed when selling. Now, contract for deed, let's talk about that. That transfers the title and the rights to the property when you pay off the note. So let's say you're purchasing a property for $200,000 and you're going to make payments over the next 30 years. The title to the property won't actually transfer to you in a case of contract for deed until you've paid off that loan in full with all the interest. So that's why this bottom line here, for subject-to transactions, I prefer to purchase in using an all-inclusive trust deed, because that transfers the deed to me immediately. Now, if I'm, seller finance is a great way to sell a property as well, because you still get that income, and you bypass certain things like having to worry about maintenance like you do on a rental property. Maintenance is for the owner. Well, if you sold property seller financing, you're not the owner anymore. You're just the mortgage company. So selling that contract for deed is a great way to do that, because it gives you control of the title while they're working on paying off that note. So let's talk about some of the tools you'll need. You're definitely going to need your state-approved REPSI. You're going to need your seller financed addendum, like we talked about. Both of those, the easiest way to find them is just your favorite search engine. We're also going to provide some examples of those to you via the tools section. You'll be able to access some of those. Now, those are for example purposes. Again, I recommend using the state-approved form, because then you know that it dots all the I's and crosses all the T's according to your state laws. You're going to need your seller finance and amortization calculator. That is a tool that we have included in your education. That's going to help you. That's going to help you plug in, like the purchase price and the interest rate that you've negotiated. And it has a place for you to do that on the seller finance side. It has a place for you to do that on the underlying mortgage side. And it runs all the calculations that you need to know on what your payment's going to be, what your cash flow is going to be, what your tax obligation is going to be. It's very helpful with all that stuff. So you're going to need that tool. And then I recommend that everybody has a one of your traditional 1980s style HP 10B2 finance calculator. In the 80s and 90s, they made them in the little pocket calculator version. It looked a lot like this screenshot of the app. It looked a lot like that in physical form. A lot of people would carry them around in their shirt pocket. Nowadays, where most of us carry smartphones, there are apps, many apps available that offer a 10B2 finance calculator. So some of those are free even. You can jump on the App Store or Google Play or whatever type of phone you have. You can download that app for free, or if you want a little more robust version of it, you can pay, I think, $2, $3, $5, $10 minimal, for a high quality product that you're going to use over and over and over again forever. Worth it, right? So make sure you get yourself an HP 10B2 finance calculator, because you're going to be using it to find out, to figure out amortization and payments on seller finance transactions. And then, most importantly, you're gonna need a relationship with a title company. I know I sound like I'm beating a dead horse here. Like, it's that's something that I'll say over and over again, and this isn't gonna be the last time you hear me say it. You have to have a relationship with a title company. But specifically, when we're talking about seller financed transactions, like a subject-to transaction, you're going to want a relationship with a title company that has experience with seller finance transactions. Some title companies out there just flat out won't do them because they don't understand them, they don't like them. Like I said, it is a little bit more of an intermediate strategy. So you want to make sure that as you're interviewing title companies to decide who you want to have that ongoing relationship with, make sure that they're well versed in seller finance transactions. So let's talk about some of the pros and cons. Here's just a few of them of doing a subject-to equity blend. Some of the pros are, the biggest one is the mortgage is not in your name. Now, Fannie Mae and Freddie Mac only allow you to have 10 mortgages in your name. And I've heard a lot of people say, well, I'll just go start an LLC and I'll get a mortgage into that. Yeah, great, but they're going to make you personally guarantee it, and it's going to go on your credit, and that counts as one of the 10. And if you have a personal residence that you have a mortgage on that's in your name, then that leaves you with 9 investment properties. But let's say you even can get 10 investment properties out of that. Long-term rentals that average about $400 a month in cash flow, that maxes you out at $4,000 a month. Now, I don't know about you, but when I think about retiring rich, the number is not $4,000 a month. It's a lot more than that. So We don't want to have that limit if of being maxed out if our strategy is to use traditional financing. So SubjectTo provides a great workaround with that. The mortgage stays in the previous owner's name, and now there's no limit to the number of mortgages that you have because they're not in your name. But you own the properties, you own those rental properties. You can pay off that mortgage obligation according to the terms of the loan that the previous owner entered into. Another nice thing is that there's no application process. It's just your ability to negotiate with the seller. Also, if structured right, you're helping people. Like we talked about, we're going to go after people who are behind on their mortgages and about to lose their houses. We can actually soften that blow for them by structuring a SubjectTo transaction. Some of the cons, one of the concerns I hear all the time is the risk of the bank calling the note due. So most banks put a clause in their mortgage paperwork that says it's called a due on sale clause, and technically a SubjectTo transaction is a sale, right? So the bank could call the note due if they wanted to. Now here's the thing: I've done tons of these transactions. I have never had the bank call the note due. I've worked with tons of real estate investors that have done these types of transactions. I don't know anybody personally who has ever had a note called due by the bank, as long as it was in good standing. Because the bank isn't in the business of owning real estate. They're in the business of collecting your payments and interest. And as long as you're making those payments on time, you're not on the radar. Like, they don't care if it transfers. As long as those payments are coming in with interest and there's no weird stuff going on, then they're not really going to care a whole lot. They're just going to be grateful that you're paying on time. So just make sure that you're not doing anything weird with it, that you're not, paying 15 days late or 30 days late or anything like that, and you should be just fine. That's not a guarantee. The bank can call the note due for whatever reason they want, not just the due on sale clause. So that is always a risk, but it's also a risk even if you have the mortgage in your name. So it doesn't change things too much. Also, there's a few extra people involved. Now you still have the seller involved because your mortgage is in his name, right? So you still kind of have to have that ongoing relationship with the seller. And sometimes they decide a few years down the road that they didn't like the decision that they made back then, and they make a fuss. That's a rare thing, so don't let that scare you away from this strategy. But you need to know that that's a possibility. So that covers everything you need to know about SubjectTo strategies and the SubjectTo equity blend. Next, we're going to talk about credit partnerships where traditional financing meets scalability. We talked about in the SubjectTo section how one of the benefits is not having the mortgage in your name. Well, you're not going to be able to do a SubjectTo on every transaction. You might have a good deal that you want to pick up, but aren't in a position where you could put a traditional mortgage in your name. That's where you can bring in a credit partner and potentially have them put the credit in their name in exchange for some equity in the property. So that's all coming up in Module 11. This wraps up Module 10. Guys, I'm looking forward to talking to you about credit partnerships in the next module. We will see you there.